Well, shares of Land's End under pressure, down about 14% following its second quarter earnings report today. The clothing retailer beat estimates but cut its full year outlook, citing global supply chain challenges and higher costs. Well, here to tell us more is Land's End CEO Jerome Griffith. Jerome, thank you so much for joining us this afternoon. So this is something a lot of retailers are struggling with, these macroeconomic headwinds and, of course, supply chain issues. What would you like to tell investors right now as they look at what they're seeing with the stock performance?
It's been interesting. If you look at the industry over the course of the last 6 to 12 months, it's been extremely volatile. And yet many companies still have the same basic fundamentals in place that they had a year ago, and we're performing fine. You do have ups and downs frequently. And listen, the supply chain has been really difficult over the course of the last 12 months, and probably we'll see some more volatility between now and the end of the year. That's been exacerbated by the fact that, inflation's been running quite rampant. And customers are very concerned or maybe a little bit skittish about shopping. What we do see is that customers that are shopping with intent, and they are coming and they are buying. It's just our concern going into the back part of the year that has been very choppy. So it's a little bit difficult to predict. I wouldn't say we slashed our outlook. We cut it slightly. But last quarter, we didn't think we would do quite as well as what we did, and we did.
Yeah, Jerome, taking a look at your second quarter numbers, they actually beat on both the top and bottom lines, comparing that to what the street was looking for. We just set it up on your screen, but revenue for the quarter, $351 million, better than what the street was looking for at $341 million. Talk to us just about this promotional environment. We've heard it from a number of your competitors and a number of other players in the retail space, just in terms of how significantly this could potentially pressure your margins in the second half. What does that look like for Land's End?
I tell you, it's really about inventory. And if you are running an apparel company and you get into trouble with inventory, regardless of whatever the reason is, it really is going to hurt you down the road. We've been able to manage our inventories extremely well. We're very much more of a basics business. About 40% of our revenue comes from what we call our basic items, and about 100 styles represent a little bit over 50% of our business. We've been able to cut orders. We've been able to pull back on things. And I think we're in a very good spot. We're up about 20% to our inventories last year. But that whole increase is based upon trying to put more goods into the chain, meaning into the time from manufacturer to in our warehouse, because of slowness in the supply chain, whether it be boats or whether it be ports or rail or trucks. And that, we believe, in the longer run, when I say long run, next couple quarters and then going into 2023, you should start to see those pressures subside. But in the short term, you have a lot of retailers that have big increases over last year with their inventories, and they're going to have to discount and continue to discount and or carry over goods into the following year.
And Jerome, when you look at the strongest parts of your business and where also you'd like to invest in the future as Land's End continues to grow, what are you keeping an eye on?
Well, we'll still continue to invest in our core business, which is our e-commerce business, both domestically and internationally. We'll continue to stay up to date as to what the current trends are. But we've got a couple of areas that have been very promising. Our third-party business, which is specifically third-party marketplaces, but then in addition to that with Kohl's and Kohl's stores, has been doing extremely well. We were up about 43% this past quarter. And we see a lot of opportunity for us down the road. We're at Amazon now. Kohl's will hit 500 stores by the back half of this year with Kohl's. We just started in Target's marketplace online and QVCs, and we've got several other options out there down the road. We think it's an area where it gets our product in front of consumers that may have heard of Land's End but haven't really spent any time with the brand, whether they're brand new to it or haven't shopped with us for 5 years or more. That's more than 3/4 of the amount of customers that we're bringing in from these marketplaces. And the other area that's done quite well has been our outfitters business, which is really our uniform business, which is a combination of school uniforms, large national accounts, and small and medium-sized businesses. The large national accounts, where we have a little bit more tendency to be in travel-related areas, whether it be airlines or hotels or rent-a-cars, has been doing quite well with the travel season over the summer. And then with school uniforms, some of that business has been pulled forward a little bit into quarter two because parents remember the supply chain issues that they had last year and they wanted to order a little bit earlier this year.
Jerome, I want to talk a little bit more about those third-party partnerships that you just mentioned, because that jumped out to me in your report, that 43% growth that you mentioned in revenue. When you're evaluating those partnerships, talk to us just about what that looks like and how big of a part of your business you think this could potentially be 5 or 10 years down the road.
One of our growth pillars is be a unit-channel distributor. What that means is we want to be where our customer is and where they're shopping and give them a seamless shopping experience. If you look backwards 4 or 5 years, you could only buy Lands' End in two places, landsend.com and Sears. And the Sears relationship was one where the customer attributes didn't really line up. And as we've exited Sears stores over the course of several years, and gone into other areas, we've said we want to be where our customer shops and spends their money. So, we have been selling online since 1995, and we have lots of information about our customer and their shopping habits. And our customer shops at certain places. She shops at Amazon, number 1, Walmart, number 2, Kohl's, number 3. And there are lots of customers that share the same attributes that our customers do that don't either know Lands' End or shop at Lands' End. So we want to be in front of them. And we think we've got a pretty long runway. It's only about 5% of our business now, but we think in the long run that could run up to 15 or 20.
And Jerome, real quick, before we let you go, certainly has been a very tough time to be at the helm of a retail business. We talk about the fact that you're facing higher prices, the fact that consumers are pulling back their spending in some areas. What has it been like just the past couple of months as you're trying to navigate and figure out what this new normal could potentially look like, at least over the coming quarters?
In a business where all I can do is really promise you change, because that's really the apparel business. It's one that's been over-delivering for the course of the last 3 years. There's been lots of challenges with managing COVID, managing increased demand, managing short demand, managing supply chain, and now gone through an inflationary period. But quite honestly, in the long run, it's a really good industry in which to participate. It's something where you stay very close with your consumer. Your consumer tells you constantly what it is she likes and what she doesn't like. You're just seeing a very volatile time, but this company has made it through lots of volatile times in the past. We'll be 60 years old next year, and I expect to see it around for another 60.